Welcome back to another explainer. Today, we're popping the hood on Targa Resources, ticker symbol TRGP. We are going to logically dissect the financial anatomy of a midstream energy giant that basically acts as a massive toll road for natural gas across the U.S. If you've ever wondered how heavy infrastructure spending today turns into massive cash flow tomorrow, you are absolutely in the right place.
But before we get lost in the numbers, let's establish what Targa actually does. They operate right in the thick of the energy value chain. They aren't the ones drilling for the oil, and they aren't the ones selling gas to your house. Instead, they are the vital middleman. They gather, process, and transport natural gas and liquids all the way from the wellhead to domestic and international markets.
Here's our roadmap for today's explainer. We're hitting the earnings paradox, the Permian growth engine, rewarding shareholders, debt and leverage, and finally, the 2027 cash flow surge.
All right, let's jump right into section 1, the earnings paradox.
So here's a bit of a brain teaser for you. How on earth does a company completely miss its earnings target, but at the exact same time post record-breaking profits? It sounds totally contradictory, right? Well, this is exactly what happened with Targa this past quarter, and it's a brilliant lesson in reading beyond the headlines.
Take a look at this stark contrast. On one hand, Wall Street wanted to see $2.48 in earnings per share. Targa missed that, delivering just $2.21, and their overall revenue actually dropped to $4.09 billion. But, and it's a massive but, they simultaneously raked in a record $1.4 billion in adjusted EBITDA. That's a 19% jump year over year. Crazy, right?
So what gives? Well, the EPS miss basically boils down to temporary headaches. We're talking severe winter weather freezing up volumes, super weak Waha natural gas prices that actually forced producers in the Permian to dial back their output, and some higher operating expenses from integrating new assets and doing regular maintenance. It was a messy quarter on the surface, for sure, but underneath, their core fee-based pipeline and processing business was an absolute cash machine.
Which brings us to section 2, the Permian growth engine.
You don't generate a record $1.4 billion EBITDA by just sitting around collecting old tolls. Targa isn't sitting still. Management is forecasting a massive, truly massive $4.5 billion in net growth capital expenditures for 2026 alone. They are aggressively doubling down on their own footprint.
What does $4.5 billion actually buy you? Real, heavy-duty infrastructure. We're talking new processing plants like Falcon 2 and East Pembroke, which literally just fired up in early 2026. Plus, they're building the Train 11, 12, and 13 fractionators, the Speedway NGL pipeline, and expanding their LPG export capacity. Oh, and let's not forget the massive $1.25 billion acquisition of stakeholder Midstream they closed in January to aggressively expand their reach in the Delaware Basin.
Moving right along to section 3, rewarding the shareholders. You're probably thinking, if they're burying billions of dollars in the ground building pipelines, what's left for the investors today? Well, quite a lot, actually. They have a fantastic dual approach to capital allocation. They declared a huge 25% dividend increase, bringing the annualized payout to a solid $5 a share. On top of that, they opportunistically bought back $55 million in stock during Q1. And get this, they still have a war chest of over $1.3 billion authorized for future buybacks.
Now, for full transparency, we did catch a bit of recent insider selling. Director Charles Crisp unloaded about $2.7 million in stock at an average price of around $256 a share. But you have to keep this in context. That trade was only about a 13.7% trim of his personal holdings. Overall, corporate insiders still hold a very steady 1.37% of the whole company, so they definitely still have plenty of skin in the game.
Let's look at how they are paying for all this in section 4, debt, leverage, and ratings.
Look, building energy infrastructure is wildly expensive, and balancing heavy capital expenditures with big shareholder rewards requires a rock-solid balance sheet. As of March 31, 2026, Targa carried a total consolidated debt of $19.13 billion. They just issued $1.5 billion in new notes in March to clear out some short-term paper and keep the engine running smoothly.
19 billion sounds a bit scary, right? But S&P Global actually just affirmed their BBB stable rating. Why? Because it's all relative to their massive earnings power. Their debt-to-EBITDA leverage ratio is sitting pretty at 3.5 times. That is literally dead center of management's target range of 3.0 to 4.0 times. They are managing this massive growth spurt very, very carefully.
And that brings us to the grand finale.
Section 5. The 2027 Cash Flow Surge. All of this spending and careful leveraging has a distinct finish line. Check out this quote from CEO Matt Malloy. He explicitly stated that finishing these mega downstream projects in the second half of 2027 is going to provide meaningful operating leverage and drive Targa's next big transformation. Essentially, he's saying they are about to evolve into a highly durable free cash flow machine.
And the numbers back this up in a huge way. Look at this shift projected by S&P Global. In 2026, capital spending is peaking around $4.6 to $4.8 billion, which only leaves a modest $100 to $300 million in free cash flow. But fast forward to 2027, CapEx cools off. All those new pipelines and fractionators go live, the tolls start rolling in, and free operating cash flow is projected to violently surge to between $1.4 and $1.6 billion. It's a total game changer.
And Wall Street is definitely picking up on this step change. Analysts over at Erste Group Bank agree with this trajectory, forecasting Targa's earnings per share to jump from $10.80 in 2026 all the way up to $12.22 by 2027. The financial community broadly recognizes the immense operating leverage that is about to kick in.
So I'm going to leave you with this provocative thought to chew on. With billions of dollars in physical infrastructure clicking into place to trigger this massive cash surge in 2027, is this fundamental transformation already perfectly priced into the stock? Or is the true value of Targa's future free cash flow still waiting to be realized by the broader market? That is the multi-billion-dollar question. Thanks so much for joining me on this deep dive into Targa Resources, and I'll catch you on the next explainer.